back. It is the Rich Paul Show, and as you know, from time to time here on the program, we like to bring in guests from around the country to give us some different perspective on things going on in the financial world. Always like to get a perspective on how macroeconomic conditions affect our own personal situation, and no better person to help us understand that than Chris Bertelsen. Chris is Chief Investment Officer for Global Financial Private Capital. Rich, take it away.
Okay. Hey, well, Chris, welcome to the show.
Happy to be here.
Excellent. Well, let me just start right off because I know we have a lot to cover, a very limited amount of time. So, Chris, with the earnings multiple now above the norms, Bernanke hinting at easing off on the stimulus throttle, if you will, later this year. Throw in the fact that we're nearing the end of a 30-year bull market run in bonds, and don't get me wrong, I'm a believer in equities long term, but it looks to me like we're in for a few speed bumps ahead. What's your take on the economy, how it's going to impact the market, not only this year, but say over the next 5 years or so?
Sure, Rich, great question, and I'm right in your camp. I think that we're due. You can call it a speed bump. I'll call it an air pocket, whatever you want. My feelings are that, when you see the average stock in a value line is somewhere around 18, 19 times earnings, well, what does it mean to the layman? What it means is that it's pretty simple. Over the last 5 years, the market has had a pretty good run. But just as you said, I don't think it means that you want to really avoid things, and which is why, my moniker for what's really available now and what excites me are things that I call stupid cheap. And boy, there's some real opportunities out there where people can get great yields and as well as find some things where they can feel comfortable sitting around waiting with.
Well, nobody minds a bargain, I'll tell you. You always want to buy things on the cheap. I know you're also a big believer in diversification as a whole and as a way to hedge risk. How do you see China and emerging markets factoring into your investment strategy?
Interesting that you say that. Just a few weeks ago, I read a little blurb that Europe was reaching a bottom and turning. I want to refocus that towards China, which I think is a real opportunity going forward. I happen to feel that China, I may be alone in this, but when you look at all of the woes that people talk about, China is not just a currency manipulator. It manipulates its economy and puts the results out it wants so it can get its commodities cheaper. And once you see the fall in price of things like copper or steel or even farm equipment or tractors and whatever, a Caterpillar or something like that, it usually means that it's a good time to step up and buy them as long as they reach the metrics of being very secure financially. I think there's an opportunity. My feeling is you look at China and you look at the U.S. and China's flat over the last 5 or 6 years and the U.S. is up 100% plus, 150%. That's not going to last forever. There's no love that I have for necessarily what China does with their economy, but I think common sense and as you said, finding a real bargain, that makes a lot of sense. So it's something we've really are looking at hard and have been making purchases over the last few weeks.
Yeah, because I know their GDP was off the charts for a while, and it's finally come back down to earth, but you still see a lot of potential there. And I think you're right. With that population base, I don't know how they can't keep producing, in terms of the GDP being where it was at and where it's at now. I believe there's a lot of room for additional growth there.
Exactly, Rich. Look at it like the U.S. in the 1950s. Now, it's not going to be double digit, but, if you're growing at 7.5% with 1 billion plus people, that's pretty impressive.
That's pretty impressive. I know that your conservative income portfolio has generated approximately about a 5% yield, which isn't so bad since about 2002, with about 2% on the upside as well, additional growth. And more importantly, I think you were able to avoid losses 2002 and 08. You see the Dow, the S&P, the NASDAQ, and if you were heavy NASDAQ, you could have really gotten hurt. In fact, you're still waiting to get your money back going all the way back to 2000. But you could have easily lost upwards of 60% of your account value during that time period. And you actually made investors money during that time period. Can you talk a little bit about that? How it is you were able to sidestep the great downturns that we had during those 2 years?
Absolutely, and I think the number one reason for us to stepping through those minefields was the fact that we really are yield grabbers. I mean, we went everywhere that you could possibly think of, as long as it had a margin of safety to find the yield. And it isn't that there weren't some periods of times when my heart was in my throat, but even in some things like stocks, like in '08 we owned Walmart and McDonald's. Well, they happened to be the only two stocks that were up at the end of the year in the Dow. So, being cautious and conservative and thinking in terms of just, what I say is basically 5.5% to 6% is what we're looking for, has been a goal that we've been able to realize. And as long as you keep that as your horizon line, I think you have a good chance of continuing to do that rather than people stretching, which I think unfortunately a lot of them did and got hurt very badly in '08 and '02.
Yeah. I know you've used these master limited partnerships called MLPs. They played an integral role in your success in getting yield out of the portfolio?
No question they have. Of course, the only issue with MLPs is that your clients, Rich, get a K1, and that's a pain in the neck from a tax point of view. But it's a good thing in the sense that it means they're making money. So we try to minimize them. But MLPs, think of them as like going down a toll road. It's no different than traveling the Ohio Turnpike or anything. All these people do is really just collect on the amount of natural gas or oil or carbon dioxide or whatever is flowing through their pipe. And they don't really care so much about the price. They just care about the fact that there's a volume going through. So it's a pretty safe model. And they're not spectacular appreciators, but they pay nicely between 4.5% and 8.5%, and that's good enough for me.
That works. Yeah, when you look at energy, oil, natural gas, and you look at the Middle East, I look at Libya and I look at Egypt, and they talk about, these places are on fire. They're just basically about to just melt down, and I think of their proximity to the Strait of Hormuz, and it's like as if we don't have enough to worry about, in this economy. What happens if they block the Strait of Hormuz? The price of oil is going to skyrocket. So having some exposure to energy is probably not going to be a bad thing.
Absolutely, and I think that you're right on. If we were to use our natural gas resources, and that's why I own natural gas, not only MLPs but other stocks that pay the dividends, is that we would be energy independent, and this huge, deficit balance that we have, and deficit per se, we'd take a big chunk out of it and create millions of jobs.
Yeah, well, that's excellent. We got about another 90 seconds or so. Let me just ask an open-ended question in terms of what do you want your final thoughts to be as it relates to the investors out there, the economy out there. There's just a lot of fear and a lot of just anticipation of what might be coming. I'm still a big believer in equities, long-term, buy equities, diversify, rebalance. I believe that works. I think you follow pretty much that same philosophy.
Absolutely, Rich, and you couldn't have said it better. Fixed income has had a 31-year bull run, and trees don't grow to the sky. Ask anybody who invested in fixed income between 1966 and August of 1982. For 16 years, they get pounded every single year. So it's not a sure thing for those people trying to make money. And the right way for us is to own those equities that really are, boring things. It's like the old widows and orphans, AT&T type stocks, where you're getting 4%, 5%, 6%, and where the businesses are going to be around in the next 5 years.
Well, I think that's going to work for a closing comment here, Chris. We're right on the button here as far as time. Listen, I appreciate your feedback here. It's been interesting. Love to have you back on at some point in time in the future. Again, thanks for the time today, and we look forward to visiting with you again soon.
Rich, thanks for having me.
And if you'd like to sit down with Rich to talk about any of these matters face-to-face, just give him a call simply by dialing 855-C-RICH. That's 855-SEERICH. Talk a little bit more about how macroeconomic conditions affect your personal portfolio. 855-C-RICH. We'll be back in just a moment. You're listening to The Rich Paul Show on News Talk 760 WJR.